Stanley Black Decker is a Dividend King, Dividend Champion, and Dividend Aristocrat that has increased its dividend for 54 consecutive years. On this graph, we're only looking at the last 20 years. You can also see that the company's earnings growth rate has averaged 8% since 2002. If I shorten this time frame to 15 years, the growth has increased to almost 12%. And if you look at just the last 10 years, it's just under 10% growth. So this has been a very consistent dividend growth stock, currently yielding 2.19%. But most importantly, if we put stock prices on the graph, these are weekly closing stock prices. You can see that the stock price has tracked the company's earnings growth, occasionally getting overvalued, occasionally getting undervalued, and it is now currently in this very overvalued market, a very undervalued opportunity with good growth going forward, a 2.19% dividend yield, an A-rated company with only 25% debt to capital. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool, aka Mr. Valuation. Once again, I want to welcome you to another one of my videos here where I basically feature a stock that I actually do like and actually am using and recommending investing in. Typically, I've been doing a lot of subscriber requests where I let the subscriber ask me about the stock and I just cover it for them so that I can clarify whether it looks like a good buy or a bad buy or whatever. In this case, this is one that I've done a lot of research on. I like the company very much. I really love the fact that, it's a dividend growth stock with an impeccable record of raising their dividend every year. And I also like the fact that I can now buy it inexpensive. So what I'm going to do here is I'm going to walk you through how I would go about evaluating this stock utilizing the Fast Graphs Fundamentals Analyzer software tool. Obviously, I'm going to do this in summary fashion. It takes me, a couple of hours to really thoroughly research a stock. So I'm going to really focus on the process I use today, but I will be highlighting, some of the things I do. And you can see where I got to spend a little time that we don't have for the sake of this video on doing that. So let's go ahead and get into the stock and get into the Fast Graph. Okay, first of all, I'm using adjusted operating earnings here. Now, adjusted operating earnings are essentially earnings that reflect how well the business has performed on an operating basis. And as I said, in the opening remarks, you can see that the orange line in this graph represents a 15 PE, which I consider a fair value PE, which offers an earnings yield of about 6.5 to 7% if the stock price is touching that line. And I consider that a fair value. You can see that in the real world, when you measure the evidence of that being a fair value, you get an awful lot of support for that statement, because when the price touches the orange line, which it does quite often, it's at fair value. When it falls below the orange line, you can see that it quickly moves back into alignment. When the orange line dips and the stock price follows that, it can do it as an overreaction. You've seen that numerous times on numerous stocks. Once again, when it starts going up, it can go up further than the earnings justify, and it recovers again. And when it gets really overvalued, it will eventually revert back to the intrinsic value. During COVID, we saw the situation where we had a lot of uncertainty, and the market hates uncertainty, by the way. And you saw this big crash, and the stock crashed, and it overshot the intrinsic value. Okay, it got really undervalued, but look how quickly it recovered. And then it got overvalued again up through about May of 2021. And since this last year, it's really been a very poor performer relative to the stock price, but it's been an excellent performer relative to the earnings growth and relative to the dividend growth. And I think that's critically important. The moral of the story is we can now buy this stock with a nice margin of safety. It's trading below its earnings justified valuation line, and it's expected to grow double digits going forward. So, this is based on earnings. If I look at the forecasting graph here, I can see now that I've got about a 10%, because these lines are 10% increments. I've got about a 10 or 12% margin of safety built in, and that gives me a factor of an 11.56% growth rate forecast as an average for the next couple of years. And that's comprised of 15% for this year. And I'll use round numbers when I talk, 10.79% if you want to be precise, and then followed by 9%. So the company is forecast to grow very nicely. You can buy it at a blended PE of 13.1 with an earnings yield of 7.59% and a dividend yield of 2.19%. That leads to double-digit rates of return out for the next 2.5 years or so. The long-term growth rate of earnings is expected to average a solid 11%. And again, that still indicates for the long run a possible double-digit, rate of return on the common stock. Now, when I look at this stock, this is what I look for as Mr. Valuation. I look for really great, high-quality companies, A-rated, 25% debt, that the market has, for whatever reason, misappraised and currently is undershooting the value of the stock. So I'm buying it with a margin of safety. But when I'm actually researching this, I start with this graph because I consider it one of the best. But I have the ability here, I'm going to go then look at basic and diluted earnings, which have a lot of accounting convention and non-cash charges involved. And what I really like about this, I don't get the correlation between the price and earnings as I did with the operating earnings or the adjusted earnings. But what I do get is I do get to see if there's any accounting convention going on when I look at these different companies. So I get a perspective of, what's going on in the business. The operating earnings allow me to see more how the business is performing as an operator. And that would tie more closely into things like cash flow and sales, which I'll get into here in a moment. Okay, then I would move on to the all-important cash flows, because when I'm looking at dividend-paying stocks, I really like to look at cash flows. Now, I don't necessarily use cash flow as a valuation metric. I will often take prices off of the graph. What I'm really looking for here is the safety and the predictability, if you will, of the dividend. Now, Stanley Black Decker did have a big drop in operating cash flow in 2021, but now they're expected to recover strongly. And otherwise, the company's cash flows have always, covered their dividend, very, very well over time. Even more importantly is free cash flow, which is the money left over to run the business. And excluding 2021, their free cash flow has always covered the dividend, which I think speaks loudly to the fact that this company has raised their dividend for 54 consecutive years. And I also might point out that they have a management team that's very committed to continuing to maintain that dividend and reward their shareholders. They're kind of proud of their status, and they talk about it quite often. But again, I don't stop there. I call EBITDA a soft form of cash flow. If you, it's earnings before interest, taxes, depreciation, and amortization. It's another operating metric that lets you kind of take a look at how the business is actually functioning and performing. And then when I put price onto that graph, once again, you see a pretty strong correlation between EBITDA and stock price. And you see, clear examples when the price gets overvalued, it gets above the EBITDA justified valuation. When it gets way below the EBITDA justified valuation, you can clearly see those represent great opportunities. And as far as that goes, we're trading at full value or fair value on the company's price per EBITDA. EBIT is simply another metric, a similar metric. It's earnings before just interest and taxes. It doesn't include a lot of the depreciation and stuff. And here we see that the company, again, has a very strong margin of safety when I look at it from an EBIT point of view. So again, I'm looking at these different metrics so that I get a good perspective overall of what the company does. I don't hang my hat on any one of these metrics, but I use the cumulative, look at all these metrics to help me make better decisions. And finally, I really like price to sales, because price to sales is another metric that's really got good valuation opportunities. You see a company's stock price will follow their sales. And once again, you see overvaluation relative to sales, undervaluation relative to sales. And currently we got Stanley Black Decker trading at a nice price to sales, but sales are expected to increase. So if I just did a quick calculation here, with the calculating functionality of fast graphs, I've got over a 9% rate of return expectation based on my price to sell. So, this is past all the bars, if you will. It's covered. I've looked at it, every aspect, every metric, and I see good, solid numbers. Now, I like to look at other areas as well. If I'm looking at operating earnings, I like to check the analyst scorecard and see how well the analysts have scored these companies. And this company has a stellar record. And for the last 7 or 8 or 9 years or so, analysts have been on the money getting this company right. Now, I kind of like that. It also implies, as I'll show you here in a moment, that the company tends to give good guidance. So now I've gone through all of the basic metrics, if you will, what I would call the important metrics, and I look at the company. Now I'm going to feature something new for you here. I'm going to take a look at fund graphs. And our acronym for fund graphs is Financial Underlying Numbers, FUN for fun. And the idea here is to go look at various income statement items, balance sheet items, cash flow statements, etc. And I can look at it in millions. I can look at it per share. I can also take a strong look at different ratios on the income statement, and look at price to basic earnings, all those things I've already looked at. But I can also look at, price to book. Now, price to book works for some companies, doesn't work so well for others, but it is available if you go through the fund graphs. And again, I'm going through this quickly for you. And then we've got this all-important new feature that's coming soon. I'm using it in our dev site here, or our admin site, I guess you would call it. It's not quite available to the public yet, but we'll be launching it soon. And the health check allows us to go through, and allows me to go through, a series of important metrics that give you, again, some further greater insights into the fundamental value of the business. So I'll start by checking margins here. And what this shows you is gross margin and, what the norm for the industry is, okay? Now, the red means it's slightly below industry norms. Green would mean it's slightly above, but don't get overly analytical with these, because what this means is I want to see good margins. I'd like to compare them to the industry, but if it's slightly below the industry, like you see here in these red bars, I don't consider that a negative. I just want to be clear on that. I consider it pretty much normal, but it does give me the ability to make an actual normalized look at that. Operating margin is also very important. How efficiently is this company operating as a business? Are they bringing some money to the bottom line? And once again, there may be some industry, places where they're deficient. They've also exceeded the industry averages in the past. And for reasons I'll go into later, I have a very strong conviction that they'll be returning to beating the industry. But for an A-rated company with 54 consecutive years of raising the dividends, I think the company's margins are good. Returns on assets are adequate here. And again, you can look at it from the standpoint of net income over total assets. Total assets are the purple line. Net income would be the lighter brown line here. But again, I've got it here based on industry standard. They're a little bit below industry norms, but they are producing positive 7-8% returns on assets. So I'm comfortable there is, a solid investment from that standpoint. And by the way, we will be having a pop-up here that, will give you a description. It's not quite loaded yet because, again, we're still developing this particular health check section. I'm going to look at return on equity in the same way, and I'm really looking for positive numbers here. The red and the green are important because that lets me know how they're doing relative to other companies in their respective industries, but there's never a perfect match there. Every company really does offer, some different business models and so on. They're in slightly different businesses. So I really want to see what the numbers are. Do they have adequate returns? And, double-digit teen returns on equity are very excellent as far as I'm concerned. Sales revenue, I'm looking for sales and revenue growth. I've got 9.33% compounded growth since 2001. Again, if I shorten that to the last 15 years, I've got 9.47% revenue growth. If I do it for the last 10 years, I'm down to 4.17, but that, is more heavily weighted by what happened to COVID when growth went from 14.4 billion in sales or revenues down to 13.1 billion. But I'm very satisfied that this company is growing their top line, quite well. Net income is important, how much they bring into the bottom line, if you will. And the company is, this is in gross dollar amounts. The company is bringing, plenty of money down to the bottom line. Asset turnover is how efficiently are they operating as far as, utilizing their assets and earning money on them. And once again, they're pretty much in line with the industry standards. They're close. They're a little bit underperforming the last couple of years, but otherwise they've done a real good job, where the industry norm, for example, is 0.81 times, asset turnover, and they were doing 0.72, so for example. So I think that's fine. Operating cash flow, from, relative to net income, they've got nice numbers all the way through. They did have a little trouble in 2021 where, the numbers got a little weak, but otherwise they're okay. Long-term debt to equity, this is actually the opposite here, industry norms versus, what the company's doing. And again, they're pretty much on the money. So looking at the health check, I would overall give this company a B, B+. looking at their health check. So now I've looked at the company from a lot of different angles, and I do that a little more comprehensively when I'm actually doing the work. I'm just doing it quickly here for this video, but I want you to see the process. Then I start going into sources where I look for information on the company. So one of the first places I always go is I go into the company's website, and, I will go ahead and look for, I'll spend a lot of time on a company's website. I'm going to look at, what our businesses, our brands, what they're talking about. And then, they talk about tools and storage. But according to Morningstar, as their company profile, just to give you a little color, Black Decker is a manufacturer of hand and power tools. It operates 3 business segments: tools and storage, security, and industrial. Tools and storage is the largest segment by revenue. It sells hand tools and power tools to professional end users, distributors, retail consumers, and individual customers. Security installs electronic security systems and provides electronic security services, including alarm monitoring and video surveillance. Industrial sells engineering fastening products such as stud welding systems, blind inserts and tools, engineered plastic and mechanical fasteners. And, it's the largest end market that they serve is the United States of America. Okay, but then I like to go in, so I'm learning about the company as I'm spending, again, some time doing this. Now, I would like to, one of the things I really like to do, now I can learn some things here about their financial performance, which is, again, from the company, but I like to go in these investor presentations, and I like to go through these investor presentations. Now, one of the things that I'm looking at is, it's a global leader with world-class franchises and expanding geographic reach. You can see the U.S. is by far their biggest, but they're also doing a pretty big business in Europe, not doing too bad in emerging markets, and then the rest of the world, is the gray area. They're doing business all over the world, if you will. With these presentations and talks about their strategic and financial objectives, I'll spend some time trying to understand that. They talk about their long-term value drivers, how they create value, their substantial long-term valuation creation. They talk about how their operating model has evolved over time. Acquisitions are a big part of the company's growth. They like to do organic growth, but they also like to, acquire new companies. They have tremendous brand power. Most of you will probably, any of you who have ever used any tools or work with any tools, know names like Craftsman, of course, Black Decker, Stanley, and so on and so forth. So Lennox, so the company is, really strong in terms of their brands. They go in and give you some information on what they're doing with things like climate change, governments, ESG as they call it. They also talk about some of the opportunities they have. They believe that the electric market for automobiles is going to increase dramatically. They expect a majority by 2026, and they're making about $30 to $60 per car compared to $10 a car looking at the internal combustion engine. So they go on here and they give you corporate guidance. They give you historical performance, track record of improved returns. They put where they are in the industry. They talk about their balance sheet and the strength of their balance sheet. And again, I would spend time on these as well as in their financial statements and the fund graphs where I've got some of that stuff organized so I can look at it easily. And they give you some, again, this is promotion on why you should invest in the company. But then I really like this section here, the guidance section. They're going to talk about, 7 to 8% organic growth. And they talk about GAAP earnings of $10.10 to $10.70 a share. Now, what I can do when they do that is I can go back into the fast graphs and I can look at GAAP earnings or diluted earnings, and I can look at what they expect the growth rate. And I'll go ahead and hone in on that a little bit. The analysts are given 7 and 25 and 8%. That's kind of consistent with the guidance that the company's putting out. They talk about their price actions to offset inflation, what they're going to do with that. They talk a little bit about currency and headwinds, which I'm interested in that. I feel like that's important, especially considering their expanding geographic reach that I talked about earlier. But, I consider their real business to be much more important for my own. They talk about their revenues and their operating profits in the various segments that they have. And again, on and on. You can go through here, and obviously there's a lot of information to be gleaned by going through the company's investor presentations. Other things that I personally like to do as an investor, I'll go into other research services. Seeking Alpha turns out to be a pretty good one where you got some crowdsourcing. and you've got, Stanley Black Decker as a Buffett-style fat pitch. So you get some information from other analysts why they like Stanley Black Decker. Again, I like them now because I consider them undervalued on top of all the reasons and very good reasons you'll find here. There are news items that you can see here. Stanley Black Decker gains on speculation of potential activists. So, this is something you'd want to take into consideration. They're really talking about an activist coming in and maybe getting them to sell their, least profitable companies and kind of tearing the company apart, but that usually would end up in profitability. It's very important to know that they had $2 billion in accelerated share repurchase program. And I want to go back into that a little bit and talk about that, because one of the things that I like to do when I'm looking at these companies, any of these companies, I like to look at shares outstanding. All right. And so I'm going to, check Stanley Black Decker shares outstanding. And there's something I noticed now, they issued a lot of shares in 2010. That can give me some insights into, what the company was doing from a standpoint of its operating results. So in 2010, the stock was pretty highly valued, if you will. And so issuing shares during that time frame was not something that I would really object to. And then also, they even had some periods where they bought shares back, and that's when the stock was more reasonably priced. And then finally, if you look at the last 2 or 3 years where the company has actually been issuing shares, not a lot. If I shorten this to like 5 years here, I got something else. I got some cash flow items here. I got net operating cash flow on there. If I look at the last 2 or 3 years, they've only been increasing their share count by about, less than 2% a year, but they have been issuing shares essentially into the fact when the stock was really trading at very high valuations. So, that was a good time to be raising capital, with their equity, if you will. And of course, low interest rates would be a good time to be using bonds. But anyway, I go through the story like this. I look at all the aspects of the company. I go through other research services. I'll look for things like Morningstar. I like to go into Wall Street Journal. I'm a subscriber to the Journal, and I like to see if there's anything, that might have alerted me, like, this is giving you some of the reasons why I can see that the stock price has been down for the last year or so. This was in February where they talked about, the company was losing market share to rivals, and it was cut to a sale. That was an article in Barron's. I'm trying to gather as much information I can, and I'm trying to look at the fundamentals as closely as I can so that I can determine whether or not I really feel strongly enough about the stock's future prospects from a fundamental point of view, especially if I have the valuation at a level that I really consider to be attractive, which I do with Stanley Black Decker here. I think we've got a chance to, invest in a terrific dividend growth stock. And for the dividend growth investor especially, I consider this stock, really something you all want to look at. You're starting out with a 2% dividend yield right now. That's about what you could have got in 2002. Let me be clear on that. You got a 2.19, we'll call it 2.2% dividend yield now. If I go into the performance back in the beginning of 2002, I'd have started out with approximately the same yield. But I want you to notice I call this growth yield. Most of you know it as yield on cost. That's why we call it that. This is broke down by the quarters, but we also total the annuals here. And you can see that the dividend, the yield on cost has increased at a very nice rate so that, 20 years later, your original 2% yield on cost is now yielding you 6.7. And the company's average growth rate of their dividend over this time frame has been about 5 or 6%. And that's attractive for a dividend growth investor where, you're fighting inflation, at least, with that kind of performance. So all in all, I think Stanley Black Decker has become a very attractive buy. I would be buying it for the long term here. If you did get lucky, and I want to emphasize that, I would feel lucky if I bought Black Decker today and the stock dropped another 5 or 10 or even 20%. I'd feel extremely lucky then, and I'd be adding to the position. So I do believe the stock is poised now that it can be very comfortably and very aggressively and very confidently added as a long-term dividend growth stock, position and investment. From a standpoint of how the market normally treats it, because of the quality, you end up getting a nice little premium on the stock of instead of a 15 times earnings, you get 16 or 17. So if you look at the margin of safety factor from, relative to the normal market value that the market likes to apply to it, it even looks any better. So that's my story on margin of safety, stock, Stanley Black Decker. Dividend Aristocrat. I hope you enjoyed this video. I've enjoyed presenting it to you. And again, I wanted you to see the process. Each of these items that I looked at here, I spent a little more time on than I obviously did in this video. I can't research a stock in, 25 minutes or 30 minutes or less. But I did want you to see the process, where I'm looking, what I'm looking at, the kind of things I like to look at. I like to look at other opinions. I go into research. I'll go into companies like Zacks, which I subscribe to. I'll look at Morningstar. I'll look again at Seeking Alpha for the crowdsourcing. I'll look for other places that I can find any information, news items, breaking news. And, of course, I spend a lot of time on the company's website. Anyway, if you enjoyed this video, then, give me a like, ring the bell. Follow my channel for future videos like this. And, also, you might want to really take a close look at FastGraphs. This tool is getting better and better. We'll be launching that health check very shortly. We're testing it right now. And we'll be adding some other new features, too, that I think you're going to find, really astounding. We're just committed to building you the best fundamental analyzer software tool on the planet. This is Chuck Carnevale saying thanks for watching.